Fitch, one of the three global credit rating agencies, just downgraded the United States from a AAA rating down to a AA plus rating because, quote, of expected fiscal deterioration over the next 3 years and an erosion of governance and a growing general debt burden. Now, this isn't the first time that the United States has seen a downgrade in their lifetime. The last time we saw this happen was back in 2011, after we had the Great Recession and after we had that big debt ceiling dilemma back in 2011. Now, interestingly, Fitch also mentioned the debt ceiling crisis that we saw happen earlier in 2023. If you remember, there was this big worry about the debt ceiling being hit. And what Fitch said was, quote, the repeated debt limit political standoffs and the last minute resolutions have eroded confidence in fiscal management. Now, naturally, when you have such a big event like this, like a major credit rating agency putting out this warning about the United States government and debt, naturally, the government's going to want to respond. And right after this statement came out, the Treasury Secretary, Janet Yellen, came out and put out her own statement about what Fitch said. And I'm going to read you a few sentences from what she said. If you want to read the entire statement from the Treasury Department, I will link it for you down in the description. But what she said was, quote, I strongly disagree with Fitch's decision. The change announced today is arbitrary and based on outdated data. Many of the measures that Fitch used, including those related to governance, have shown improvement over the course of this administration. Then she goes on to say that Fitch's decision does not change what Americans, investors, and people all around the world already know, which is that Treasury securities remain the world's preeminent, safe, and liquid asset, and that the American economy is fundamentally strong. And then she ends by saying that President Biden and I are committed to fiscal sustainability. So now I want to jump into why this is so important to understand, what this means, and really why does this even matter and what you need to know. But before I jump into that, I want to remind you that on August 15th, I'm going to be hosting my first ever Investor Summit. If you'd like to join me, I'm going to be going over how the economy has changed, but even more importantly, how you can capitalize on new investment opportunities in this economy. This Investor Summit is completely free, but you have to register to join. We have a limited number of seats. So if you'd like to join me for this free live Investor Summit on August 15th, I got the link to how you can join me down in the description below. Now, to lay the foundation so we're all on the same page, there are three major global credit rating agencies. You have Moody's, Standard & Poor's, and then you have Fitch. And their job is to essentially rate different types of credit and debt. That way investors know the risks associated with investing their money in different places. If you've ever seen the movie The Big Short, they covered what the different credit rating agencies do pretty well. And what was supposed to happen before the 2008 crash, which the credit rating agencies did not do a good job of, was these credit rating agencies should have notified investors of the risky investments that they were making by lending money or investing money into mortgage-backed securities. Because you had all these banks, all these investment institutions, all these hedge funds that were dumping money into mortgage-backed securities, which were essentially, think of it like baskets of a bunch of different mortgages. So if you went out and bought a mortgage, these mortgages would get bundled up into these different securities, these different things, and then sold off to investors. Well, investors were learning from these credit rating agencies that there's nothing wrong with these mortgage investments because all these mortgages are healthy. That's what these credit rating agencies were saying. So their job was supposed to let investors know if there are risks associated with certain types of credit investments, debt investments. Well, when you lend money to the government, if you go out and you buy a treasury bond, a treasury bill, a treasury note, what that means is you are literally lending money to the government, and in exchange, the government will pay you back with interest. If you've read any financial or economic book ever, every financial and economic book states that the riskiest or the risk-free investment, I don't know how to say that properly, the least riskiest investment is lending your money to the government. That is known as the risk-free rate because the government always pays their bills. They always pay back their debt. Now, sometimes they have to print money in order to pay it back, but the government always pays back their debt. This is what every economic book tells you, which is why when you look at the treasury yield, which means the interest rate that the government pays you for loaning money to the government, that is known as the quote unquote risk-free rate. So if the government is going to pay you, let's just say 4% a year on a 10-year loan to the government, a 10-year bill, that means that the risk-free rate is 4%. And so the reason why this is so important is because now when you have a major credit rating agency downgrade the United States from AAA down to AA+, it's still a very low risk investment. AAA means essentially as close to risk-free as possible. But now when you take a risk-free investment, these treasury bills, treasury bonds, treasury notes, loaning money to the government, and now you say it's a AA+, that means that it's a little bit more risky than what people thought. And so you're telling investors around the world that, hey, maybe it might not be a risk-free investment. That's why this is such a concern. Because yeah, a AA+ investment is still a good investment, but it doesn't have that same risk-free kind of perception that many people have grown up being told. So that is what kind of raises the red flags about what's going on with this downgrade. Now, this isn't a complete surprise because in May of this year, back when we were dealing with the whole debt ceiling dilemma, Fitch put out a notice saying that the AAA rating for the United States debt is on a negative watch, and they were blaming the debt ceiling. What this said was, this is what Fitch said right now. In Fitch's view, there has been a steady deterioration in standards of governance over the last 20 years, including on fiscal and debt matters, notwithstanding the June bipartisan agreement to suspend the debt limits until January 2025. So essentially what they're saying is, yeah, we had all these debt ceiling issues. There's issues with the growing national debt, and there's potential issues with the economy as well. And because of all these concerns of things that are happening in the economy, changes with the governance in the United States, changes in the way that we spend money in the United States, they felt compelled to then lower their own rating of the United States. Now, the reason why this matters for you is because, well, if you want to go out and borrow money, one of the factors that impacts the interest rate that you pay on your mortgage, on your credit card payment is, well, the interest rate. And the factor that influences the interest rate is the treasury yield. Because now let's think about this. Remember, the government pays out an interest rate. If you lend money to the government, anybody, you, me, anybody can go out and lend money to the government. We can go out and buy a treasury bond, a treasury note, and that means we're lending money to the government. Now, if the government is paying us, say 4%, that is the risk-free investment. If a bank now wants to lend you money, why would they want to charge you less than what they could get by just lending money to the government? Because they can get essentially a guaranteed return, right? Risk-free rate by lending money to the government. In which case, they're going to want a premium to let you borrow money to buy a home. Which means if now investors are potentially worried about the return that they're going to get from the government, they might demand higher interest rates from the government. And if investors demand higher interest rates from the government, that could push treasury yields higher. Treasury yields are the interest rates that governments pay. If treasury yields go higher, that means the quote-unquote risk-free rate is going higher, which would then mean that mortgage rates would have to go higher, car payment rates would have to go higher, credit card rates would have to go higher. Actually, I found an article from the New York Times back in 2011 after the last downgrade happened for the United States debt. And this is what the New York Times said. This downgrade in 2011 could lead investors to demand higher interest rates from the federal government and other borrowers, raising costs for governments, businesses, and home buyers. But many analysts say that the impact could be modest, in part because the other rating agencies, Moody's and Fitch, have not decided to downgrade the government at this time. So what that means is, if it's just one credit rating agency, and the reason why I'm looking at the past is because, well, history doesn't exactly repeat itself, it does rhyme, which is why one of the best indications of what might be coming is to pay attention to what has happened in the past. In 2011, we had one credit rating agency, Standard & Poor, which downgraded the United States. And the risk and the concern was, is that going to make investors now demand higher interest rates from the government? If that happens, that's going to push up mortgage rates, it's going to push up other debt rates. But because it was just one credit rating agency, it didn't create a massive change to treasury yields. Today, we're in a similar boat. We've had just one credit rating agency, Fitch, downgrade the credit ratingness of the United States. If we see a second credit rating agency do the same thing, that could create more concerns to interest rates, because now more credit rating agencies are getting in agreement about the risks of lending money to the United States government, which could then push up treasury yields, which could then push up mortgage rates, which could then push up car rates and everything in between. So that's the first factor that you want to pay attention to. And the second factor is really just concerns on the economy. What Fitch is talking about is really over the next 3 years, what's going to be eroding when it comes to the economy and kind of the government spending ability. And what it seems like is what Fitch is saying is that over the coming 3 years, that's what they said. Fitch said in one of their statements that in the coming 3 years that we're going to see changes in fiscal deterioration. What does that mean exactly? They didn't go into a ton of detail on that, but what they're talking about is interest rates are going up. If interest rates are going up, that means the interest rate the governments have to pay, our United States government has to pay on all of their debt is going to be higher, so higher interest payments. In addition to that, we could also be seeing a slowing economy, which means less tax revenue for the government and less economic growth. And so when you tie all these things together, that poses a concern to Fitch, which should be an indication for investors, you, to say, okay, there are concerns out there. This means I need to get financially smart. I say this all the time. 2023 is not the year for you to go out and finance a new truck. 2023 is the year for you to get financially smart. That means use this as a time to get financially educated. Use this as a time to get prepared. Now, this is one of the things that I'm going to be talking about in my live investor summit, about how the economy is changing, about how you can capitalize on opportunities and build your financial education. Again, you can join me for free by using the link down in the description. But this is where it is so important to understand that there are red flags out there. Hey, maybe nothing will happen, but it doesn't hurt you to be prepared, and it doesn't hurt you to be financially educated.